Pawn shops are not retail stores. They are banks with shelves. Every item behind the glass represents a loan, a risk, an interest payment, and a bet on whether the customer comes back. Today, we break down how pawn shops turn everyday objects into short-term credit and how liquidity becomes the real product. In 2026, roughly 9,000 pawn shops operated in the United States, originating an estimated $15 billion in loans per year. Most people walk past them without a second thought. Underneath the neon signs and dusty guitars sits one of the oldest, most misunderstood financial models around. We'll cover the loan-to-value math, the interest structure that makes the business work, the default equation that fills the shelves, the appraisal risk that can sink a shop in one bad bet, and the regulation that separates survivors from shutouts. The core transaction, how a pawn loan actually works. A pawn loan is collateralized. The customer brings in an item. The shop appraises it and offers a loan based on a percentage of what it can sell for. Cash changes hands. The shop holds the item. Repay the loan plus interest and you get it back. Default and the shop keeps it and sells it. Loan to value. Shops typically lend 25% to 40% of estimated retail value. A gold chain worth $400 might get a $120 loan, a 30% LTV. That looks brutal to the customer. To the shop, it's the safety net. At 30% LTV, they can sell the item at half its retail value and still break even. Term structure. State laws set terms at 30 to 90 days, and many let customers extend by paying only the interest, not the principal. A customer can renew a $120 loan indefinitely, paying $15 to $20 a month and never touching the balance. That's where the real money lives, pawning versus selling. About 80% of customers walk in to sell outright, not to pawn. The shop buys at 30% to 50% of resale value and shelves it immediately. Clean, profitable, but not the engine. The engine is the 20% who pawn, generating recurring interest on the same collateral for months. The interest engine, where the money is actually made, this is where it gets uncomfortable. On paper, pawn rates look predatory. The numbers are what they are. Rate math. Caps vary by state. Florida limits pawn shops to 25% per month on the first $100 and 10% on the next $500. Texas allows up to 20% monthly. Some states set no cap at all. A $120 loan at 20% a month costs $24 in interest for 30 days, roughly 240% APR. Next to a 25% APR credit card, that number shocks, but the comparison misleads. Pawn loans aren't installment credit. They're 30-day collateralized loans. Most get repaid or default within 60 days. Nobody carries one for a year at 240% because the item would already be forfeited and sold. Revenue breakdown. A healthy shop pulls 50% to 60% of gross profit from interest and fees on outstanding loans. The rest comes from retail sales of forfeited inventory and outright purchases. Interest is steady, retail is seasonal and lumpy. Fee stack. Many states allow ticket fees, storage fees, late fees, and processing fees on top of interest. A $120 loan might carry $24 in interest plus $5 in fees, $29 total for 30 days. Those fees cost the shop nothing to collect, pure margin. The default equation, what happens when customers don't return? Roughly 70% to 80% of customers repay and reclaim their items. That leaves 20% to 30% defaulting, and those defaults aren't losses, they're inventory. Take a shop with $50,000 in outstanding loans. A 20% default rate turns $10,000 in principal into merchandise. Lent at 30% LTV, that merchandise carries an estimated retail value near $33,000. Sold at 50% to 70% of that, the shop collects $16,500 to $23,000. Add roughly $2,000 already collected in interest before default, and total recovery lands between $18,500 and $25,000 on $10,000 at risk. The default isn't just covered, it's profitable. That math only holds if the appraisal was right. Lend $120 on something believed worth $400 that actually sells for $80, and the whole thing collapses. Appraisal accuracy is the single most important skill in this business. Every day on the shelf costs floor space, insurance, and carrying cost. Shops that can't move inventory within 90 days start drowning in dead stock. The appraisal risk. The bet behind every loan. Every loan is a bet that the shop knows what the collateral is worth. Get it wrong often enough and the shop closes. Overvaluation is the most common killer. A fake Rolex or gold-plated chain fools an inexperienced appraiser into lending $500 on something worth $30. The customer vanishes. The shop eats a $470 loss. Misidentification covers stolen goods. Most states require shops to report every transaction to police, with photos, descriptions, and customer ID. Skip that step, and a confiscated item as evidence costs the shop both the merchandise and the loan. Market risk hits hardest with gold. Drop the spot price 15% in a month, and a shop holding $80,000 in gold-backed loans suddenly holds collateral worth less than the debt against it. Conservative LTV makes this manageable. Aggressive LTV makes it catastrophic. The gold anchor. Experienced operators love gold because it's liquid, measurable, and priced by the second on public markets. A shop can melt it and sell to a refiner within 48 hours at roughly 95% of spot, with almost no appraisal ambiguity. Diamonds and gemstones get harder. Brand name watches, harder still. Electronics are the toughest of all. Fast appreciation, thin resale markets. The liquidity premium. Why customers choose pawn over everything else? Why pay 240% APR when credit cards exist? Because pawn shops serve customers credit card companies won't touch. The customer profile. Average pawn customers carry credit scores below 620. Many have no bank account, some are undocumented. Nearly all need cash today, not in 2 weeks after an application clears. No credit check, no income verification, no waiting. 10 minutes and cash is in hand. The speed premium. That speed matters enormously to someone facing eviction, repossession, or a medical bill due Friday. They aren't choosing between a pawn loan and a credit card, they're choosing between a pawn loan and nothing. Liquidity is the product. The interest rate is the price of getting it immediately. The repeat customer. The average active user pawns something 4 to 6 times a year, often the same item on a cycle, a piece of jewelry, a tool set. That $300 gold chain, pawned every 2 months, generates $60 in interest per cycle, $360 a year, off a single piece of collateral. These repeat customers are the annuity. The verdict: how the winners win. Is the business worth it? Yes, but the industry is consolidating fast. The losing model is the standalone shop run by an owner who appraises by gut, keeps paper tickets, and has no inventory system. These shops make too many bad bets and can't track their loan book. They're dying off. The winning model is the multi-location operator, standardized appraisal training, digital pawn software, integrated police reporting, centralized gold refining. Companies like First Cash and Cash America have rolled up hundreds of locations, run the same playbook everywhere, refine gold in bulk at better rates, and shift inventory between stores to match demand. Their cost per loan is a fraction of a single store owner's. The technology shift has brought online pawn into the mainstream. Customers upload photos, get an appraisal within hours, and receive a bank transfer the same day, with items held in a centralized warehouse. No storefront needed for that slice of the business, and the unit economics look dramatically better. The regulatory wall is the final moat. States keep tightening pawn law. Lower interest caps, mandatory holding periods, stricter police reporting, tougher audits. Compliance is expensive for a single shop, but scales efficiently across 50 locations. Regulation is quietly pushing small operators out and rewarding the big ones. A pawn shop isn't a retail store that happens to make loans. It's a lender with a retail exit strategy for bad debt. Interest pays the bills, defaults fill the shelves, and gold keeps the lights on. Speed is the actual product. If this breakdown helped you see the numbers behind the glass, let me know in the comments. Want more businesses that operate in plain sight? Hit subscribe.